Imagine losing almost your entire core market in 2 years, only to pivot so hard into AI that you trigger a massive, explosive stock rally. Welcome to Earnings Unscripted. It's July 14th, 2026, and today we're unpacking a wild fourth quarter for Aehr Test Systems, ticker AEHR. Honestly, Miro, what a survival story. What's your first reaction here?
It's an incredible... Honestly, it's a fairly unprecedented structural pivot. They essentially swapped electric vehicle components for silicon photonics on the fly. The headline metrics are solid. Revenue hit almost $19 million, and non-GAAP earnings came in at 11 cents a share, which completely reverses last year's losses. But those backward-looking metrics aren't driving this market reaction.
Well, before we look forward, I should probably do the usual housekeeping. Just a quick reminder that everything we talk about is purely our personal opinion, so please don't use this podcast as financial advice. But you're right about the reaction. The tape was absolutely violent today. The stock gapped up hard going into the close and then just spiked heavily in extended hours. So what's the market actually pricing in?
They're pricing in the backlog. They booked over $60 million in new orders this quarter alone. That's a staggering jump, and it's fueled entirely by the sudden need to stress test complex AI processors before they get glued into expensive data center substrates. If you assemble a bad chip today, you don't just lose the chip, you throw away a vastly more expensive package.
Which nobody wants to do when they're racing to build out infrastructure. I actually love how the CEO, Gayn Erickson, framed their physical advantage here. He basically said you could fit enough of their testing machines to support demand into a 20-car garage. Meanwhile, competitors would need to fill massive bunny-suited clean rooms to get the same output. It really humanizes why they're winning these contracts.
Right. They have an extreme density advantage. But to me, the real anomaly in this report isn't the physical hardware. It's the balance sheet. They posted a profit and they run a super capital light model, so they really shouldn't...
No, exactly. They shouldn't need a bailout. Yet they quietly sold off a massive amount of stock to stockpile cash. If they don't have heavy physical expenses, what's the reason they're suddenly building such a huge war chest?
Because working capital is a monster when you scale this fast. They need parts to build that massive backlog surge we mentioned. So they used an at-the-market offering to pull in about $97 million in net cash. Retail momentum gave them an opening, and they just took it.
That's honestly pretty shrewd. If your stock is surging on the AI narrative, padding the balance sheet without taking on debt is just good defense. But if they're building all these systems, why was their capital expenditure only roughly $2 million for the whole year? Where's the factory?
They don't have a new one. It's this phantom factory concept I actually love. They activated a contract manufacturer in Southeast Asia to do the heavy lifting. They're projecting output of dozens of package-level burn-in systems a month directly from that partner. So local fixed infrastructure stays tiny while output goes parabolic.
Okay, wait, I'm trying to picture this. So Aehr just ships the blueprints over. The overseas plant pumps out the machines, and then Aehr just slaps their logo on it, like drop shipping hardware?
No, that's not quite it. It's not a white label situation. These are highly complex proprietary Sonoma systems. The contract manufacturer handles the heavy assembly and integration, but Aehr is still sourcing the critical supply chain, driving the engineering, and guaranteeing the spec, which is actually where their biggest headache is coming from right now.
There's always a headache in hardware. What's breaking?
The universal components market. Turns out the third-party power supply vendors who build parts for Aehr's systems, they're also supplying to Nvidia.
Oh, so because the hyperscalers are sucking all the air out of the room, suppliers can just name their price for the smaller guys.
Exactly. It's proximity inflation. Erickson was pretty blunt about it on the call. He said, some of the power supply manufacturers that we use in Sonoma are supplying to Nvidia and others. They've come back and they've raised their prices 40% if you want to get them.
40%!
That's just outright supply chain extortion.
Right, except margins somehow held up. They posted a non-GAAP gross margin of around 45% this quarter. They absorbed that pricing pressure through higher capacity utilization and shifting to wafer-level products, which naturally carry better margins than last year's package-level mix.
But they can't outrun that forever. If the components cost more, they eventually have to pass that on to customers or eat the loss.
Sure, but the real stress test for their operations comes in the second quarter. Management says the bulk of a single $41 million AI order is going to ship entirely within that one tight time frame.
Jeez, they're shoving the lion's share of their revenue into one quarter. So what happens to their utilization metrics before and immediately after that massive order clears the assembly lines?
It's going to look incredibly chaotic. Management is flat out warning that deliveries are lumpy. Q1 is decent. Q2 spikes wildly because they process that massive AI order we mentioned. Q3 goes basically flat, and then Q4 ramps up again.
That sounds like a communications nightmare. I mean, how do you even guide Wall Street on something that jagged without everyone panicking?
You give them a huge full-year target and tell them to wait. Their guidance full-year revenue somewhere between 130 and 150 million.
Wait, the bottom of that range is nearly triple the revenue base they just finished on. Are they assuming they win literally every single contract they're bidding on?
No, actually, that's the kicker. That guidance assumes absolutely zero revenue from high bandwidth memory testing.
Wait, they aren't modeling HBM at all? Isn't that the biggest testing bottleneck for these new processors? I thought they'd be entirely reliant on that.
Right, you'd think so, but they aren't. They built that forecast purely on current backlog. If an HBM contract actually lands, it's just pure upside.
Okay, but look, we talked earlier about their heavy concentration. Doesn't this absolute reliance on AI scare you a little bit, considering their core EV market vanished on them last year?
It would, except they're quietly locking down that legacy automotive business. Ericsson literally quoted top-tier EV companies mandating them, saying, "We specifically have automotive EV suppliers telling their suppliers, go get Aehr."
Oh, wow, like an explicit industry mandate.
Exactly. When your end customer forces you onto their subcontractors, you don't really have to sell anymore. Plus, they just had 2 patents upheld in a Beijing court against their main local competitor, Nexus Test. So the IP mode is holding up globally, too.
Honestly, considering they looked dead in the water a couple years ago, watching them pull off this pivot feels like watching someone parallel park a bullet train.
That's actually a pretty accurate description. It's a wildly aggressive maneuver, but they definitely jammed it into the spot.
Totally. I think that's a perfect place to leave it today. Thanks for listening to Earnings Unscripted, everybody. We'll catch you after the next call.
Always a pleasure. See you next time.
If you're having fun with these quick updates, consider hitting follow on your podcast app. Just to pull back the curtain, this entire episode, both the writing and our voices, is a completely synthetic AI experiment, turning today's raw filings into a finished conversation on the exact same afternoon. We'd love to hear what ticker you're keeping an eye on next, so drop us an email at earningsunscripted@datamadness.ca or check out our X link in the episode description.
Talk to you soon.